When you talk about stocks, most of the time people will tell you when you're new to diversify in order to prevent risk. Considering the inherent risk in investing, you'd want to be able to mitigate your risk so you can keep investing as you go. In the stock market, nobody wants to invest in something that will only lose them money, so making sure that your investments are secure is one way to keep your money. This is Intelligentsia, a life device for practical and financial goals. Today, we want to talk about diversification, why you should diversify, and how it works. So let's get to it. When you talk about diversification, we're talking about not putting all your eggs in one basket. When it comes to investing or managing your money, you need variety in order to avoid losing everything when something fails. Imagine you have a variety of different foods in your lunchbox instead of just one type. Each type of food offers something different, maybe some are healthy, some tasty, and some filling. If one of those suddenly spoils because it turns out that the expiration date for that specific piece of food is today, you lose everything if you decide to only pack that instead of picking one of each. In the same way, diversification in the stock market or in finance in general means spreading your money across different types of investments like stocks, bonds, real estate, and more. This helps you reduce the risk of losing a lot of money if one type of investment doesn't do well in the long run. The idea here is that putting your money in one thing is risky. If it fails, you lose all of your money instead of just some of it. Much like in the lunchbox analogy that we've talked about before, if you decided that you didn't like one part of your lunch, you still have others to enjoy and benefit from. By diversifying, you want to have a balanced and safer financial portfolio that can weather ups and downs in the financial world. It's definitely a way to mitigate risk and increase the likelihood of overall financial stability and growth over time. Some beginners, however, like to double down on one or two stocks. Generally, that kind of advice works well for active investors that understand the market and would like to maximize their gains in the shortest amount of time. Even with analysis included, the risk in investing in one stock is still greater than investing in multiple ones. Let's break it down further. Let's say you're running a lemonade stand and you're starting out, spreading the risk. Granted, if it's popular and sells really well, you end up making a lot of money in a short amount of time. If you only sell one type of drink, in this case lemonade, and sudden changes affect how your drink tastes or your customer's mood involving your product, you run the risk of losing your profits over time. You've invested in this one thing, and unfortunately, since you don't have anything else to offer, you just kinda lose out on money as a result. But if you offer different flavors or other drinks, you're not reliant on just one and can still make money even if one isn't selling well. The key point we're trying to make here is that if you only offer one or if you invest in just one thing and it fails, which all things have a possibility to do so, you just lose. Protect your savings. If you put all your money into just one flavor or drink or type of investment, and that flavor becomes unpopular, you might lose a lot of money. As with the prior example, if there are changes in the market, you just lose out on money that you could be making. But if you have different flavors or different investments, even if one doesn't do well, the others can help balance things out. Generally, you'd want a backup in order to continue making money out of your initial investment. If you perform badly enough in one, you can end up losing everything if you don't have others to back you up. Maximize opportunities. Some people like different flavors, and on other days, they prefer other flavors. The market's changes don't always favor you, but if you cover all your bases and have diversified, you'll continue to make money off of different investments even if one falters. One example of this is if interest rates are high, banks make more money, but if they're low, real estate agencies are allowed to borrow more for lesser interest. Business or company-specific risks are unique risks a company faces. As a result, if you're someone that overinvests in one sector or one company, you end up being unable to recur your losses if it somehow fails. Changes in the market happen constantly, and it's up to you, the investor, to understand that some changes benefit some industries while detrimental to others. Some company-specific risks include management issues, law and regulation changes, and many others. Understand that the negative effects on one company doesn't necessarily mean the same for others in the same sector, but it helps to analyze whether it's company-specific or industry-wide. A diversified investor always takes less risk with their investments. Some examples of these are Spreading your money around. Imagine you have a basket of different types of bread. Instead of putting them all in one basket, imagine you put them in different containers with different types. You have rye in one basket, you have baguettes on the other. Each basket is like a different investment. We need to have a mix of stocks, bonds, real estate, or savings. They all function differently, and as a result, they don't behave the same way depending on how the market is doing. Invest in different industries. It's like being interested in different hobbies. Some days, the industry favors technical hobbies like video games or multimedia arts. Other days, you'll feel like trying your hand in more traditional arts like painting or pottery. Investing in different industries allows you to spread your money across different sectors and allows you to mitigate risk when the market's mood swings in favor of a different industry. Industries like tech, healthcare, finance, and more. If one industry isn't doing well, the others might be doing great. Consider various regions or countries. In terms of geopolitical climate, different countries have different restrictions, cultures, and tastes. It's common to invest in different countries as they have different economies and different needs. If one country's economy is having a tough time, companies in another country might be doing well, helping balance your investments. Mix low and high investments. Think of it like having a mix of high protein with high calories and low calories but high in flavor food. You may benefit from one in terms of nutrition, but you bulk up immediately, and most of the time, you'd want something more exciting but doesn't offer much in terms of nutrition. You need to have a mix of both high risk with potentially high reward investments like stocks or lower risk investments like bonds to balance the safety and gains in your portfolio. You'd want to be able to maximize your profits if one stock is doing really well, and you need a stable backup for whenever the risk you take doesn't pan out too well for you. There's always inherent risk in trying to trade in the stock market, but always having a good backup allows you to take more risk in the future that can lead to high rewards as a result. Consider time horizon. If you're someone that makes it a habit to save up for big ticket items like a new bike or a new phone, generally, saving money has a specific time frame for when you'll hold onto your money before making the purchase. For investments, think of short-term goals like buying a car, medium-term goals like a house, and long-term goals like retirement. Choose investments that match your time frame so your money grows when you need it. Diversifying is just having different tools in your toolkit in order to have an answer to everything the market may potentially throw at you. Understand that while you're able to reduce your risk, since you're spreading your money around, you're also effectively diluting the amount of money you actually get. If one stock performs really well but you haven't put enough in it to see substantial returns, you would have lost out on that opportunity. Diversification is just one strategy that helps you out in the long run, but it's just one of many to learn. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.